All right, so thanks again for everybody tuning in. We were kind of throwing this together, make sure everybody could get the word out there. January 31st, 2022, and basically this is an update for the market since we are starting to see some things fly. Well, I'll get into it because I got a whole story to explain about this. So basically, what's happening is we are seeing the UVXY lead, and that is the leveraged ETF of the volatility of the VIX. And when I'm able to make large, easy trades on the UVXY, that means the market's not healthy. The UVXY should be going down, the market should be going up. And when the UVXY starts popping 50% or so and in 2 days, and then starts to consolidate to set up again, yeah, that's saying that some volatility is coming into the picture, into the market, and we're starting to see some issues. So these are some of the recent trades. I actually took a little bit of a trade counter trend, and I faded the UVXY for a quick little 13.5%. So that was pretty nice. But other than that, we got a nice 53 and almost 45. I mean, the whole move went like 57%. So I was just trying to scale out because sometimes the UVXY can turn around in a hurry. So we got that. This is what the trade looked like. These are the alerts that I sent out, and this is how it went. And basically, what I was seeing was the UVXY consolidating right in through here and doing some of the patterns that I talk about to the Moxie group and to the classes and the style of trading that I have. We put on one position and then we put another on, and poof, just went up straight like that. And then because I figured it was going to fade all the way back down to the moving average, we took another trade down there for like another day and a half, almost 2 days of a trade. And so that was pretty nice. And I do think that it is setting up again. So it could be a little tricky when that gets in there, but it looks to be holding up fairly well from what I'm seeing. So wouldn't be surprised to be seeing another big move coming up in short order. GLBE is another trade that we took, and this one is kind of a pretty good example of a lot of the moves that I'm seeing out there. Part of it is the duration. This was a 6-week trade. It's one of the longer trades that I've taken, but the trend was really good, and the trend is to the downside. I'll show you in the next slide. But for 6 weeks, just sitting on it. I mean, all we had to do is we just bought in once, or borrowed the shares once, and then we sat on it for 40%. That's a pretty cool 14,000 off of 21,000 cost basis. So really nice moves that are happening out there to the downside. So that's kind of what's happening. Is let's watch out. GLBE, you can see here, I was trying to short it right in through here because it looked like it was doing this kind of thing like that and then breaking down. We had to ride through it a little bit, but there was an inverse trampoline move on the daily chart, and I'll be getting into that a little bit more about that. But nice 40%. Right now it's just kind of chilling sideways, but pretty easy 40%. And just look at this kind of move. This is what we're seeing out there. And I don't think, well, the short side isn't always very long, but I do think that we're going to have some more here that we can work with. So what we'll be covering in today's webinar is what's going on. Is this the start of a bear market? Is this something that we're really going to have to be careful about and see what's happening and throw everything away? Or can we kind of work with this? What is the Fed doing? Short answer, a lot. Is there an economic slowdown coming? We keep hearing some rumblings about that. What's safe? Where can we play that is safe? And what am I doing about this market? What are some of the strategies that I'm employing? And basically a whole bunch of short trade examples so you guys can see what I have been doing. All right, so let's dive in. What are we in for? So the whole backstory of where we are today all started all the way back in February of 2021. And what that was is when the IWM stopped going up. So here's the IWM on the weekly time frame. You can see we just rip roared for 2020 into a little bit of 2021. And this to the dot was February 15th. That is when the first crack in the market started to show up. That's when all the crazy mid caps and the really crazy names stopped going up. I mean, these are the things that, it was going to change the world, and we're going to be in all new batteries and electricity and solar and all this other kind of stuff. That was the day the things just quit right there. Now, I was still fairly bullish. I thought the market was going to hold off for a little bit, because if you look at the IWM, it was really just trending sideways. And it's trending sideways into moving averages like this and all that. And then the real crux of when things got going was the failed breakout was the real sign of everything else starting to drop. So you can see this was the failed breakout. I mean, it looked like everything was good. We're going to start firing on all cylinders and we're going to be off to the races again. Well, you know what? That got stuffed real quick. And then the confirmation of the downside was right here when price hit the underside of the daily 50 with the Moxie indicator below zero. That is textbook Moxie short setup for this stock indicator, whatever. That was textbook. So that is when everything else started to really roll over for us. Now, the IBD, this is the FFTY, this is the ETF of the IBD 50, and they are the leaders. You know, they did break out before the IWM broke out, and they also double topped before the IWM topped, had its failed breakout. So this was the failed breakout on the IWM. FFTY was already double topping, and then they are clearly leading the way down because, I guess I didn't show you this. If we go back to the IWM, we can see here there's still a gap between price and the weekly 50 SMA or weekly 200 SMA. And if we look at the IBD 50, it's already there. So they are in fact leading the way, and that's why I'm a little concerned about where some of these prices are going to sink to before this whole thing is over. So if we go a little bit further, and I'm looking at this. This is the ARK ETF. It's on the weekly time frame. Now, no disrespect to ARK, that's fine. But what I do want to show is that if you like what they're doing and what they're investing in, that's great. You can ride them up. You can have a money manager run an ETF for you based on whatever it is the basket of stocks are. But that's really all it is. Still just a basket of stocks that are kind of getting changed around a little bit. And you know what? There's the Moxie price trigger on a weekly time frame telling us when this move got started. And here's the Moxie price trigger telling us when the move is over. So, go trade their stuff. You can trade an ETF just like you can trade a stock. And all I want to show you is that the Moxie indicator on the weekly time frame was all over it on both sides. So this is some pretty impressive stuff from the indicator, and also telling you, you got to watch out for when you start seeing these levels and then they just break right down there. Notice, just like the IBD 50, like the IWM, this one is also down to the weekly 200. Now, there might be some support, there might be some bounces, but that's where they're going. Now, I started trading all of my family's money when COVID hit because my family's money was in a managed account, kind of like this or whatever, and it was just following the market lockstep down. I thought I could do better than that, and so I did. And that's when I started breaking off and trading my family's own money. And then, as far as simpler trading, I've been with them a few years now, been having a great time helping a lot of people learn the market. And if you guys are interested in finding out more about me, you can find me on Twitter and Instagram and all the social media stuff like that. So one thing I like to talk about, because everyone's like, well, do you just have a special knack for this? Like, no, I was not born knowing how to trade. None of us were, and I went to one of my first sessions here when I was 12 years old. My dad actually took me. It was in Texas, funny enough. And I remember asking one of the presenters, like, is this really possible to trade for income? And I was told that no one was born knowing how to trade. And I didn't know at the time, but that was one of the most important phrases I would ever hear. And that really helped me take on the challenge of trading full time, because it meant that it was, number one, teachable, and number two, learnable. And that's what I kind of figure out. And now I am on the other side doing the same thing that so many other mentors and other traders have given to me, the years of information and understanding and education. And now I'm here trying to turn it back around and give out what I've learned. So a little bit about me as far as my interests. I'm also a pilot. I basically grew up in an airplane. My dad's a pilot. My grandparents are pilots. So I was like 3 when I had my first flight. Obviously not by myself, but you need to have a lot of discipline in order to be a pilot. You need to follow your checklist and all that stuff. And if you're reckless, you're going to be killing your account. You're not going to have a good day flying the airplane either. And so my goal as a market pilot is to get there and help you get there wherever there is, and making our dreams happen one trade at a time. And right now, getting there safely is more important than ever as the market is starting to correct. 2020, I think, was pretty much a perfect storm. I think we all see that and we recognize that, and we looked at what happened, and it was absolute insanity. But you know what? The amazing thing is that even though the market's crazy like that, I know how to take advantage of it. I took a $700,000 account and turned it into 5.5, which was 785% gain. I mean, this looks like the IWM. It is absolutely bonkers. But I think the perfect storm was the combination of technology, social media, and free trading. So technology, we have Thinkorswim. We have so many different trading platforms, and they're really good. They're really strong. They're good for user interface. We can do it on our laptop, our mobile phone, our tablet. I mean, anybody who wants to get into trading, they can. The barrier of entry is really low. Then we have social media. Think of Reddit. Think of Wall Street Bets. Think of any of the other chat groups. Think of like what we're doing right now. Think about the ability for us, for me right now, to reach how many people, and we all talk, and we could, in their case, coordinate to do short squeezes on the big funds. And then free trading. It was a race to zero commissions. Options you still have to pay for, but at least for stock, you don't have to pay to trade stock anymore. So the barrier of entry is just really, really low. Plus, you add that with the massive stimulus shot, and the market shot up like a geyser. Now, the only problem is with a geyser is they shoot straight up, and there's really nothing underneath them. That's ultimately the problem, I think, of what the market is experiencing, is that going up too fast is not a good thing. The way I like to look at this is the problem with going up too fast is that there are no layers of consolidation formed to act as circuit breakers or tree branches on the way down. And I really like the analogy of tree branches. You got to think about, as price goes up, you can see that it kind of goes up and then maybe it'll rest for a little bit and then goes up and rests a little bit and then goes up and rests a little bit. And then maybe you get a blow off top. And you know what? When that starts to come down, what's it going to do? It's going to hit a level, and it's going to come down, hit a level, and come down, hit a level. Well, when the market basically just goes like this and then consolidates, there are no levels. If price wants to start rolling down, it's going to roll down and it's just going to blow through all these levels because there are none. And that is basically the phenomenon that has occurred in 2020 with so many stocks. And you can see that with the IWM, and you can see that with individual stocks. I mean, go look at Blink and Plug and whatever out there. These names that just went vertical, they're all air pockets underneath. And now that they're finally starting to roll over, they're coming down. So this is a lot of what I'm going to be discussing in upcoming class, because I do want to be showing some people how to short and how to take advantage of some of this stuff. So an old phrase that an older trading friend of mine uses every time, because he likes to trade growth stocks too. They go up like rockets, but they fall like rocks. And we are seeing that. We've been seeing that. And while if you on the short side can take advantage of it, it's nice. It's real nice. But if you're on the long side, you better just watch out. And that's kind of the biggest thing, is just watch out. And so the thing, as far as with the IWM, the rut here, just notice on the monthly time frame, it hits the third ATR, and then it pulls back. Look how many times it does that, and look exactly what it happened here for 2020 into 2021. And then the concern is that now that it's gone sideways long enough and actually broken through the monthly 10, where else does it tend to go? And I'm just showing examples. Just look at the chart. Look at that. Went to the weekly 50, weekly 50, weekly 50, weekly 50. Now 20 was an exception, but then the rest of it all went down to the weekly 50. There is a good chance that the IWM could go all the way back down to the weekly 50. And if you look left, where is the area of consolidation? It's there too. There is nothing here as far as consolidation goes. It's just looks like it's going to free fall until it gets down there. So I look at something like this, and I'm, for better or for worse, whether it's concerning or awesome, I think there's still some room to go. So just be careful about that. All right, so the market has changed. That hasn't been clear. The first crack in the bull market was mid-February 2021 when the speculative names reversed. We saw that. Then another wave of degradation came in June after a little bounce in some sectors and when Delta became prominent. Then the mega caps hit their peak in November when Omicron was discovered. Now, I'm kind of wondering what the heck's going to line up next. Now, I don't know if the market was necessarily responding to Delta or Omicron, but they sure line up. And I thought that was quite interesting. I don't know if there's another variant looming out there, or is this just going to be rate hikes and quantitative tightening and all that? But it's amazing. It's absolutely amazing how the market lines up with certain things in the world out there. It's just never ending fascinating. So I just was looking around at all the stocks that I like, and I came across, FCell was one that I traded, and I looked at its dates because I remember living through this stuff. We went through this. We saw, oh, there's a bounce there, and oh, there's a run there. And going back, making this thing and looking at history and looking at those dates, I was amazed to see that obviously FCell was one of the crazy moves, And it was one of those, I mean, this was insanity. This is how we were making 700% trading stock in 2020. This is the stuff. And this peaked. Look at that, February 10th, just to a dime. And then we got that nice little bounce here, June 8th, but it was counter trend as price went up across a downtrending moving average like that. And then this other one, I really wasn't expecting this to go like this, and so I kind of missed the boat on that one. But I was looking for a pullback. The Moxie subscribers remember I was kept looking for a pullback, because I'm looking for the daily 50 to be support. And you know what? The pullback just never stopped. I was never ever able to find a long in this. And then next thing I realized, like, oh, these are shorts, and they just keep going. Like even here, you can see that there's a level of support. What it do? It just kept going through it, which was astonishing. So I'm looking at this saying, you know what? I wouldn't be surprised if this thing goes all the way back to where it came from, and it might go further. So the 4 market phases. This is something, whether you're new or old, you need to know this. We were, accumulation phase. Okay, fine. We kind of saw that F cell. It was kind of bumping along, not doing much. And then 2020 came along and said, hold my beer. And we got the advancing. This was amazing. We got it for a little over a year in some names. Other names, they're still going a bit. But then I think most of 2021 was distribution. And I'll show you some internal graphs that really help elaborate that and show it. And getting into that, we've seen the distribution. It's going sideways. Money's coming out of it. Some of them have already really, really gotten into the declining phase. But there are others like the big cap, the mega cap, Tesla, Apple, whatever. They might be for a period of time in distribution, and they might starting to get into decline. Now, that doesn't necessarily mean they're going to go all the way down, but I think that something like this is starting to happen. We need to be aware of the 4 market phases. This is basically rinse, wash, rinse, repeat, and right now we're kind of in number 3 and 4. So why was 2021 so difficult? This is a good way of looking through the internals and saying, why was 2021 so difficult? And I know it wasn't just me. I heard from all over the place. People are like just having the hardest time out there. Not only did the small caps start their decline mid-February, which is right there, even through the NASDAQ. If you look at this is the NASDAQ. The internals in the NASDAQ, they peaked in mid-February too. And this is how many stocks are above the 200-day moving average, which is a pretty long-term trending moving average. You can even see the 50 topped at that point too. So clearly something was going on, and that was an issue. And so what this is telling us is just look at the decline and how this thing kept going down and down and down and down, and it was telling us that there was a problem. So we can see that just we never went bullish. The internals just never went bullish again. And so what was happening was money started to flow and concentrate into the big cap mega stocks. And so that's where it's been flowing. And they're the last ones to go, of course. And only 15% of stocks are now over their 200-day moving average. This is atrocious. So going with the flow, short versus long, like what worked before isn't going to cut it in the near term. I know it's frustrating. It also means, but there's also opportunity. I think right now that down is the obvious trend, but corrections don't typically last very long. So we kind of need to hit it while we can. There can be quick money made, but beware of short covering rallies, biggest in a downtrend. Fix that. So particularly after a correction, there is a supreme fertile ground for the long side. That's really what I'm looking for. So Apple topped for now, and actually I called it here mid-December. This was a post that I made in my trading room. I said, look, this thing is super extended for all these various reasons, and it did in fact the next day go down. And then after that, it came up here, did an inverse trampoline move. This is price over the 50, but notice that the Moxie indicator never got over 0. It's an inverse trampoline move. That told me this thing wasn't going to work. Plus, it was a double top. And then we saw another inverse trampoline move. And right now, we're in the midst of another inverse trampoline move. So we look at this, and I know Apple is up here. I'm not shorting it yet. I'm trying to guide some people. There's been great moves. You can trade this to the upside or to the downside. And what I'm looking at is this is the arch of the foot. If you guys know my setups and systems, you know why I'm looking at that. If you don't, well, then I have classes that I can show you and teach you about all this stuff and why it's working. So I'm looking at this and saying, I think this is just a bounce before we get some more downside. So another one like this is Chewy, and this one is already been in a downtrend for months, actually just months. And if you're going to be trading the short side, you basically take your rules and you turn them upside down. You take your trading system, you turn upside down. Of course, there are a little bit of tweaks here and there, but what we're looking at is yet again another inverse trampoline move. Price should not be over the 50 if the Moxie indicator is below 0. There's also an inverse elf shoe in there too. But then the other thing is you short at the top. Now, how do you know where the top is? Well, again, you go back to the patterns and things that I teach. And for me, the ideal place to short when it lines up is at the arch of the foot. And you can see that these things are working out perfectly. Very, very perfectly. And then over here, you can see there's the Moxie price trigger that tells us that the Moxie indicator is now below 0. And so it's declining. You can see price is going sideways, Moxie indicator going down. Yeah, it's a problem. And then right here, price ran right smack into the underside of a downtrending moving average with the Moxie indicator below 0 again. And yet again here, it hit the underside of a downtrending moving average also. So this is just what you look for. You short the bounces on those kind of things. Here's another one, RSI. You have price running into the underside of the 21, arch of the foot. Got the same thing here, same thing. Dip, bounce, dip, bounce. And then how about this? Inverse trampoline move. Yet again, price over the 50, Moxie indicator below 0, looking great. That's the kind of stuff that I'm talking about. So this is why I'm talking about like Apple and some of these other ones. Like these inverse trampoline moves are starting to set up all over the place, and it's looking good to the short side. So just again, whether that's good or bad for you. If it's bad, maybe you need to step out of the market, but understand that we're starting to see a ton of weakness across the board. And again, running right smack into the underside of the moving average, and again to the 21 arch of the foot. Just look at the Moxie indicator, how red it is, all that kind of stuff. So, and then how about this? Just kind of a smorgasbord of looking of what's going on out there. We got Shopify, and I tried pulling names that were kind of across different sectors. At this point, they're all starting to look pretty similar to each other, right? Now, I have here, it says, where are the consolidation areas? Go look at some of the stocks that you're trading. How about TPX? Yeah, there's a consolidation area. And you know what? Price is right here. It's bouncing a little bit. But what happens when it finally chews through all of that consolidation area? Do you see that there's much consolidation right there? I don't. You know what? Sure looks to me like there's a pretty big air pocket right there. There's a good chance it might go there. Because if you just look at the others, where are they going? They're already there. So I think we're going to be looking at this, and it could be fun for the short side coming up, but we got to do it right. You got to have the tools. You got to kind of know how these things are going to be working to this way. You can see the Moxie price trigger here has been triggering. These are on the weekly timeframes. I mean, look how good, look how precise. That is telling you that momentum has now changed from the upside to the downside. And you know what? They're falling off of these moving averages. They can't hold their moving averages anymore, and so they're starting to decline. And these are the things that we need to start paying attention to. We can't keep our head in the sand for what's going on out there. Now, what's also been difficult about the market is we look at the index and we're like, well, the index is up, up until like a week ago or 2 weeks ago. We're like, oh, the market's still doing fine. It's still up. It's still at highs. In fact, the market made new highs. And this is, I always kind of, it's a little bit of a joke, but I'm always afraid of new highs because there's always a pullback after a new high. Whether that pullback is a small one or whatever, but there's always a down after a new high. And so you just never know when is that last one going to be. And it was right there. So what I wanted to show through here, and we're looking at the big caps, and if you just kind of look at that, look at financial news and TV, you're like, oh, things kind of look okay. It's because they're not looking at the rest of these things. They've just gone by the wayside. People are only looking at the big flashy things. They're only looking to the long side. They don't tell you when to exit. They don't tell you when to get out of these positions, do they? They only tell you, oh, Apple, Microsoft, they're cheap right now. Go buy them on the dip. They don't tell you when to get out. So over the last 6 months, and this was from December, 4 stocks, Microsoft, Apple, NVIDIA, Google, have generated almost 70% of the S&P's return. And you can see that here because these the crosshairs are exactly in the same location for SPY versus RSP. And you can see just how much higher the SPY went than the RSP went. And that just kind of tells you how much influence those larger timeframes or larger stocks have on the indexes because they're weightings. Google, one of those big mega caps. What's going to happen to the market when Google isn't pulling it up anymore? And we saw this inverse trampoline move on the daily time frame a few months ago. I mean, we were talking about this. This right here is price over the daily 50. Notice the Moxie indicator is below zero. I remember talking about this in the options room, the training room and stuff, saying, yeah, this is going to be a problem. I at least need to see price come back down to the daily 50 because people are asking me right here if they should go long. I said, I'm looking for that pullback. I'm a little concerned about the Moxie indicator still being below zero. And then you know what? Look what happened here with price basically chopping sideways. And what was the Moxie indicator doing? It was falling apart. This is the stuff that I'm trying to see and communicate and tell people like, hey, this is not good. And somebody else was asking me today about some stocks being super low, like really, I don't know, Roku or something being really, really low. And hey, can we buy this? It looks like it's at some support and it's super low. I'm like, we are so far away from these things going positive again, because I know not everybody's familiar with the Moxie indicator in this presentation, but look how far below the indicator is from zero. That's got a lot of work to do before it ever gets positive again. This is gonna be a while. So I know Google has earnings. It could pop. I don't care. It could bounce, but eventually this thing's gonna roll back over. It's gonna find some support, but then it's gonna run into resistance. And I think these things are pretty certainly gonna roll over again. And again, look at the inverse trampoline move. Price over the 50, the Moxie indicator below zero. These are perfect short opportunities. And because of that, the Moxie indicator is also telling you that you shouldn't be in here. Like, it's telling you this is a false long. Don't get suckered into something like this. And this inverse trampoline move is exactly what I'm looking at on Apple right now. So more declining internals. This one's on the S&P now. The SPY did better as it was plateauing basically over the summer, but then started to decline going into August. Basically, when we think seasonality should be picking up, like coming out of summer into the best season of the year, we should be seeing the market start to really work. And while the indexes were up and there were some big name stocks trading well and whatever, really the internals were declining. So this is really, really a problem. Yeah, we kind of saw a bump in through here, but that was another fake out. And the problem is, look at this. We are now below the 50% line. Fewer than 50% of stocks are over their 200-day SMA. This is not good. 2018, which is the point that I keep referencing, saw a 12% print. We're at 48%. 2018 saw 12%. So if you guys don't think it can't get worse, just think about that. Now, I'm not really referencing 2020 because obviously we know that's kind of an exception and it went basically to zero. But if you guys don't think it can't get worse, it can. And again, maybe it's relative. Worse could be great if you're trading the short side and if you know how to trade the short side. So, if we think that there's going to be more opportunity to downside, then yeah, it's great. It's like some quick money because things tend to fall off a cliff. All right, now this one's kind of fun. I really like getting into this. So 52 week new lows have been surging. We have been seeing weakness show up in the new lows as they have dramatically surged in November. Now remember, November, just kind of put that in your brain right now for the next slide or two. So in November, you could see that the 52-week new lows were really starting to really explode. And then they're still exploding. And we have been seeing Hindenburg omens starting to fire. Now, what is a Hindenburg omen, you ask? Well, the Hindenburg omen is a technical indicator that compares the percentage of new 52-week highs and new 52-week lows. Basically, if the spread of that is too great, you start getting Hindenburg omens, and it's basically predicting the likelihood of a market crash. They don't show up often, and they're only right 25% of the time, but there has never been a major market downtrend without a Hindenburg omen. So when they're right, they're really right. And the Hindenburg omen suggests that it is abnormal for stocks to be making both new 52-week highs and 52-week new lows at the same time. You kind of think about it. It's like, okay, market's in an uptrend. We are experiencing a surge of new 52-week lows. What is that telling you? It's saying that a lot of names are really starting to fall apart, even though the market is up, even though we're in a bull trend. But then you're starting to get new 52-week highs. You're like, well, where are they coming from? Those new 52-week highs are from defense. So this is why you need to remember late November, because as new lows were starting to surge, we got a breakout in XLP. We got a breakout in like Coke and Pepsi, General Mills or Kellogg's, stuff like that. Stuff that people just don't trade. they're only going there because it's safety, relative safety. And so you got to look at this and say, well, what the heck's going on out there? And so XLP broke out as a defensive sector as those new lows started expanding, which basically helped trigger the omen. Now, as far as the S&P and trying to look at a roadmap, look, I definitely don't know where price is going. We need to make that very, very clear. But here are some things to consider going back from what I was talking about earlier. Where are those tree branches? The first place that price found support at was a consolidation area. Look at it right there. Now, you could argue it was maybe the weekly 50, but you can see it definitely went below the weekly 50. But look, there was an area of consolidation. There's even an area of consolidation right there, and price is right there. So tree branch, right? Now we're getting a little bit of a bounce. I do think that this is going to go lower. I think the market's going to roll over after this bounce at some point. I don't know how long it's going to take. But then you ask yourself, well, where's the next area that it could go? And at least just looking from a consolidation area, like where is some tree branches? And you also line that up with 20%, like, oh, look, this is what I'm talking about, how the market is fascinating sometimes. Look where the next layer of consolidation is. It also happens to be at 20%. Funny how that lines up, right? Now, again, I don't know if it's going there. It might go further. It might not go as far, but it's just something to kind of look at and be considerate of and be prepared for. Now, I also don't, I really hope it doesn't go this far because that would probably be real disastrous and that could make some worse things. But, looking at the IWM, looking at ARC, looking at the IBD, looking at Square, I mean, a lot of these names are heading towards their weekly 200s. I'm concerned if the SPY does go to the weekly 200, but I will just note so that it's on the record, it is where the next major area of consolidation is. So we'll have to see. It's way too early to even call that, but it's just I want to put it out there. All right. So another thing to kind of consider about why this is all happening and what are the metrics, and is another COVID variant out there, or is this just quantitative tightening? It could also be, if we look at quant studies, it could also just be, hey, this is kind of normal for midterm years. 2022 is a mid-year election year, a year cycle. And historically, the average is almost 17% decline over, however many months it takes. But then on the other side, and this is why I'm pretty hopeful that once the correction is done, there will be immense opportunity to be bullish. Because if you look at this, a year later, the return is 32%. Pretty amazing. It's double. I mean, that's an amazing stat right there. It goes down a certain number and it pops back up almost double. That's pretty cool. And so I'm really excited about this because, hey, not everybody can trade short. I really like to trade alongside. It really makes people feel uncomfortable, and 401ks are getting hurt when the market goes down. But you know what? It's kind of like a forest fire. It's good. It's good. You get nutrients, you get seeds, you kind of clear the deck, you wipe out the underbrush, you weed out the cheap companies, the bad companies. And you know what? When the dust settles and the fire's over, you figure out who the strong companies are, and they just flourish. New trees, new foliage, all that kind of stuff. It's great. So honestly, this is a good thing if you can just write it out or take advantage of it. But when we are on the other side of this, it should be a good thing. We just have to make sure it actually happens. So I went back, kind of looking through some stuff, looking through charts, trying to figure out what this might actually look like. And I came across 1998. And on the monthly time frame, I realized, like, oh, wow, this really kind of looks like our current situation, doesn't it? So in 1998, the market went down 20%. It went below the monthly 10. And it was pretty steep, it broke the weekly 50 and went down here. And look again with the consolidation. Look at this. How's that for a layer of consolidation, and price went right to it? And that was 20%. Now, fortunately, you can see that price did not go to the weekly 200. So that's kind of why I put it out there. Like, we won't go there yet. But it is very interesting to see consolidation and 20%. And then you know what happened? This thing rocketed and went 50% within a year. If we actually took that stat earlier and said, okay, well, where was it a year later? It was a little bit softer. I think it was like 38%. But it went 50% in the course of the year. That's the kind of stuff. That is the clearing of the slate and regrowth that I want to see. So for as much as anybody might be worried out there, I really want to kind of put a silver lining on there and say, hey, let's just get through this. Let's see if we can make some money on the short side. And then after that, theoretically, we could have a good time. We just have to see how it actually plays out. There's no guarantees, no promises. Now, again, I do think that this is a correction, not a bear market. It is setting up to be something pretty stiff, I think, but I don't think it's a bear. You can look here. Here was 1998. You can see it was basically just a little dip. And then you can see even 2015. And 2015 was a really crazy time because it did a wild double bottom. I've almost never seen one of those on such a large time frame. I was trying to trade through that. It was a little tough. But even that, even as much as it came down there, it never actually got rejected by the underside of the monthly 10. And then we have 2018, which is kind of one of the ones I like to compare to right now. And you can see it never got rejected by the monthly 10. And even 2020, for as much as it went down, it got right back on top of the monthly 10. So where are we right now? I mean, we're just now touching the monthly 10. Now, I think we're going to go below it. We've already spiked below it, but we're probably going to have a month or two below it, maybe 3, 4, who knows. But the difference between a spike down and a move up like that, like buy the dip kind of thing on a monthly time frame, and a bear market gets underneath that moving average and then turns that moving average down and then flags into it and gets rejected by that moving average. I mean, look how clear that is. You can see that clearly price is following the underside of this moving average. So this is why if a bear market's going to happen, we're going to see it. We're going to see it from a mile away, and it's going to be pretty obvious. And there's going to be a whole lot more stuff out there to show us. But for now, we need to consider this basically just a giant buy the dip, but the dip's not over yet. All right, so here was another fun one. I like to, well, of course, I watch John Carter's videos, and in a previous market update, he told us to watch the TIP. I'm like, what the heck is the TIP? And so it was inflation adjusted bonds, and I didn't really get it, whatever. But he's like, yeah, watch this. I'd never heard of this thing before. He said, watch this. As long as this thing's going up, the market will be fine. But if it starts going down, watch out. And I remember kind of watching it here, and I was like, oh, maybe that's a problem. And then, I kind of keep an eye on it. And then now that the market is breaking down, I look at this thing, I was like, oh, holy cow. Look at this. Not only do we have a Moxie price trigger to the downside telling you that this thing is starting to run out of energy and wants to roll over, we have a double top and it's breaking support. And this is this month. This happened just a couple weeks ago. And you can see it's breaking support here on the monthly chart too. Whereas before we had support and now the weekly 50 is no longer support. So how funny is that? I mean, that thing really worked out. And then flight to safety, right? That's kind of what I was thinking. If the market's going to be turning down, people are probably going to be looking to gold, talking about gold, all that kind of stuff. And I did take a couple of gold trades. I was bullish on it. I was leading the Moxie group into it. And I was looking at gold. I was looking at the gold miners. I was looking at one in particular, GFI was looking great at the time until it didn't. And kind of looking back at it, I think there are two things of why gold is not going to work out. Number one, this all got decided just last week when the FOMC came out and the dollar spiked. That's number one. Like that mechanically is the reason why I think gold is getting stifled, because a rising dollar is going to have a hard time for gold usually. It's not always perfect, but I think that right now is going to be an influence. The other situation is when you consider real interest rates are rising. And we think about that, okay, large funds or governments or whatever, people who need to make any kind of, they just need to park their money someplace. They need any kind of return. Well, now that we know that interest rates are going to be going up, well, they can start putting their money in better fixed income type places that they can have a guaranteed rate of return, something to that extent. And so we can see here that I think that's going to be part of the issue, because now they don't need to take the risk of gold, because gold's still risky. It's still, we don't know if it's going to go up and down and all that kind of stuff. It can go down. But if they can put their money in a place that gets a guaranteed rate of return, even if it's small, then they're going to go that direction. I think that's putting some pressure on gold. So another thing that's going to be affecting the market, we've been talking about this one for a long time, right? Everyone's talking about inflation, inflation, inflation. Well, how is it actually affecting us? Where are we seeing this? Because the market is people, and we have to think about, well, do people have money to put into the market? I have a barber. He was telling me, yeah, he's buying the market right now. I'm a little worried about that, but he's putting money into the market. He's like, yeah, market's down, put more money into it. It'll turn around. Yeah, maybe. But what if inflation goes up and he has less money to put into the market? That's one way to look at it. And so I asked my mom, actually, because she does the grocery shopping and she knows the prices. I was like, well, what is yogurt and cottage cheese and milk and I don't know, anything else that we buy? Like, what's been going on? She's like, oh yeah, so-and-so went up by 20%. I was like, or 20 cents. I said, well, what was the price before? And so I did the math, and I was amazed. Like, it was spot on. The real inflation of goods out there is easily 10 to 15%, even though the government is saying the inflation 7%. We kind of know that's not the real number. So my mom's experience based on just the prices has been 10 to 15%. I mean, what the heck have you guys been seeing out there? I'm sure you have. Gas pumps, groceries, just goods. The other thing that I'm seeing too is my sports physical therapist raised his rates from 150 to 175. And I was like, I wonder what percentage that is. So I did the math, and lo and behold, I was like, 16%. Go figure. So he just raised his rates by 15%. And then my wife stopped buying a certain cow-based dog treat because the price went from $15 to $40. Now that's a little bit less than 3x, and I'm sure there are different reasons, because probably cattle and supply chains and workers and all that stuff is making it super expensive. But that she's not buying that anymore. And this is going to have repercussions all over the place, whether people have to spend more of their money on stuff or they just choose not to buy those things. And this is going to, and I think it's going to have an effect on the market, as we see. And we know that inflation's bad. I mean, everybody kind of knows that. So the question is, what is the Fed going to do to address this? Well, their tool right now is to address it by rate hikes. The market is forward looking. We know that. We know also that these rate hikes were going to come eventually, because having rate hikes or having interest rates go down to zero is always a temporary fix. We know that they're going to come back eventually. So we could be in the process of readjusting prices in anticipation of a slowdown. And we were initially thinking there were going to be 2 rate hikes in 2022. Everybody, it feels like forever ago, but does everybody remember? We're like, oh yeah, only 2 rate hikes in 2022. That's when they're going to start turning this thing up. But then inflation reared its head and things are getting out of whack. And now it was then now 3 rate hikes. And now I'm hearing like 5 rate hikes that the FOMC is saying. Well, if we go over to Bank of America now expects the Fed to start tightening in the March 22 meeting, raising rates by 25 basis points at every remaining meeting, which we get, for a total of 7 rate hikes in every quarter in 2023 for a total of 4. This means that Bank of America's target for a terminal rate of 2.75 to 3% will be reached in December 2023. Now, however that's going to affect the market, it's up to you. We just have to watch the charts. Maybe the market can handle it. I think that there's been some data to say that, yes, the market can handle a rising interest rate environment, but not all stocks can handle it. There are stocks out there that have way too much debt, they can't service their loans with rates going up like this. They don't turn revenue. They're going to go belly up. They're experimental. There are going to be, again, going back to the forest fire analogy, there are going to be a lot of stocks that do not come back from this. They just won't. So if you're in a position that is sucking wind, reconsider it. You don't need to hang on to these things. You can just get out. It's really a good option. Now, we've also seen some data showing that disappointed expectations recently, indicating slowing growth and momentum. So, and as a result, JP Morgan now forecasts growth decelerated from 7% quarter over quarter to a trend like 1.5% in the first quarter of 2022. Now, while this is not yet a recession, Bank of America said they were stunned the market when its chief economist joined JP Morgan, slashing his GDP for 2022 and especially for Q1, where his forecast has collapsed from 4% previously to just 1%, a number which Zero Hedge is confident will drop to 0 and soon negative if the slide in stocks accelerates due to the impact financial conditions and the lack of wealth effect have on the broader economy. Now, that's an interesting thing to think about. The wealth effect. Right now, people are feeling happy. 401ks are up, housing prices are up, everything's looking pretty good. And you got to understand that the economy is a bit of a psychological beast. If people feel like the economy's good, if people feel like the economy is going to be going up and they feel like they're going to be doing better next year than this year, they're going to spend and project and plan that way. But when they think things are turning or changing, or they have to tighten their belts, maybe their house isn't worth as much, maybe their 401k is going down, and they're like, ooh, oh, that's starting to sting. They're going to change their behavior. They're going to change how things are, and maybe they're going to stop spending money out there They're like, oh man, the market's not doing too well. I can't really do too much. I'm getting close to retirement. Any number of reasons. So it can be a little bit of a snowball if things start to happen like that. So just kind of keep that in mind out there. Stagflation. Now, maybe you guys haven't heard this word in a long time. And this is not a good situation either. So I don't know if this is going to happen, but it's something I just wanted to be talking about out there as, again, kind of an overall market thing to be considering since it is being talked about a bit. But the initial GDP Now model estimates for real GDP growth in the first quarter of 2022 is just now 0.1%, basically on the verge of contraction. That's what that's saying. Now, stagflation refers to an economy that has experienced a simultaneous increase in inflation and stagnation of economic output. It's pretty much what's happening right now. We've got inflation, and our economic output is being stifled by kind of coronavirus and labor and all these other issues. This is why our supply chain is really having a hard time. Like we're having a hard time putting stuff out. Another theory states that stagflation is caused when a sudden increase in the cost of oil reduces an economy's productive capacity. Now, oil is going up, and it's going up for other places around, and a lot of times that could be considered a good thing because for the oil industry and all that. But if oil prices go up, it's going to be more expensive. Energy is more expensive. It's going to be more expensive for countries or manufacturers or whatever to produce things because their costs have now gone up. So that's one thing. Another example is when a government prints currency, which would increase the money supply and create inflation. That's exactly what we've seen. And while raising taxes, which would slow economic growth, resulting in stagflation. Now, this isn't political, but the Build Back Better plan basically does both. From my understanding, it does raise taxes in a lot of different ways. And what is it? What 1.2 trillion is kind of what we're up to right now. And they wanted 3, I think, before, and it's down to 1.2 trillion. So whatever, if this gets passed or not, that is something to be considered, that there is going to be more money printing, more money going into the economy, and taxes will be raised. And it is kind of something that we need to understand about. Yeah, I know it's over 10 years, but it's still a thing. Like just because it's planned over 10 years, it's still, this is what we're talking about. And again, it could be any side of the government. We just need to understand what the government is doing, not necessarily which side. All right. Now, on the topic of housing market, I thought this was fascinating. I've been watching this chart for years. This is the Case-Shiller Home Index, because you probably always hear about the Case-Shiller Home Index, or like whatever. And I thought, I'm into trading stocks. I wonder if they chart this. And I did some searching years ago, and I found, yeah, they actually graph this. And so this is the national home price. They have different regions, but this is the main one. And when I started looking at it and putting my moving averages on it, and I look back at basically the only time it really mattered, I was like, holy cow, this is incredible. This looked like a blow off top per se. And then it traded exactly like a typical stock chart, which I was like, I wonder if housing can trade like a stock chart. Look what it did. First of all, you get kind of an exuberance run like this, and then you get price crossing under the moving average. And then remember, just like a couple slides ago, how I was talking about a bear market, it then got rejected by the underside of a downtrending moving average, and it continued that all the way down until it reversed. This is typical chart patterns for stocks. This is exactly how the cycle goes. And once it finally bottomed, what did it do? It got over the moving average, then pulled back into the moving average, and then followed the moving average. I mean, I personally think this is pretty bonkers because nobody buying a house ever looks at this. But how funny is it that our human nature, just how prices work and how the market works in the aggregate, because this is hundreds of thousands of people doing transactions, and look how well this actually fits to a typical stock chart with a 10 SMA moving average on the monthly chart. It was mind-blowing. So look at where we were, look at where we are now. Kind of looks similar, doesn't it? So not that 2008 is going to happen again, but as far as the housing market probably slowing down and we're probably near the top or something like that, just the chart wise kind of looks like that. And the other thing to consider is with interest rates going up, it's going to pretty much put a kibosh on the housing market, I think, because the reason why the housing market exploded, other than people working remotely and wanting to expand a little bit more, is because interest rates went down. It's super easy. It was like, holy cow, for the same monthly cost that I was paying on my mortgage, I can now get a bigger, more expensive house and still have the same monthly cost. That is the reason why people just blew up and bought houses because they could. And now that interest rates are going to be going up, it's going to put a little bit of crunch on it. They're going to be like, huh, it's now more expensive for me to buy the same house because of the interest rates. So keep that in mind, see what's going on in here and yeah, what's going on with that, especially with interest rates. But I'm telling you, it's fascinating to put the housing market on a chart. So are there any safe places to hide during this period of time? Short answer is no. If the market goes down, it will pull most names with it. The best you can hope for is something that can stay mostly neutral. Of course, there are always exceptions. There's going to be something that can go up and kind of buck the trend. Maybe oil is that thing. I'm not sure. I'm not really in the game of right now of playing that because I think I'm just playing the trend. But here's a really good example of what you're looking for. If you're trying to find a place to hide, if you need to hide out, or basically if you're trying to find the next winner after this happens, because remember, a pullback tends to lead to a really good rally. You're looking for relative strength. Here's Hershey from 2018, and you can see these lines are in exactly the same time as each other. And you can see that 2018, the market went down 20%. What did Hershey's do? Basically nothing. So this is what funds, hedge funds, firms, the company that trades your 401k, this is hopefully what they're doing. This is hopefully their trading plan is they're like, we just need price to not go down. We just need to hide out someplace. And that's what we're looking at. So as long as it doesn't go down, they're like, that's great because the market just went down 20% and we basically went nowhere. That's amazing. I'm happy with that. For us, we have the benefit of being in cash. Do you really need to just, is it so bad that you need to park your money here? Maybe it is. We got some big traders here. Maybe you guys need to find some place to put your money. Sure. But for the rest of us, we can be nimble and we can just be in cash. We can trade to the short side. We can be in cash, whatever. But what I would do is when the market fixes itself and comes back out, I'd be looking to say what didn't get hit. Those are probably going to be some good trades. So that's what I'm going to be looking for over the next few weeks to months. So WDFD, what do funds do? By law, they are required to have a certain percentage of their money invested at all times. They literally can't go to cash. Plus, they have a liquidity issue. They just can't, they can't get out of certain stocks because they own so much of it, and they would be all of the stock if they moved it. This is why sector rotation is a thing. This is why we talk about it, because basically there's so much money in the system. It can't leave the system. It just has to bounce around the room. It has to go from here to here to here to find alpha. It has to find, okay, what's going up or what's going down the least. So for a lot of firms out there with all the money that's out there, basically losing 5% and something like Hershey's is much better than losing 40% in Neo. That's the name of the game for the next few months as the market starts to correct. So just kind of keep that in mind. That's why Coca-Cola and Pepsi and stuff like that are doing decently well. That's why oil is trying to do pretty well. I just don't know how much upside they're going to have. It's kind of a slow moving animal for me. Now, decision fatigue. I was in the chat room, I think it was last week when the market was doing its pullback, and then we had the FOMC and the market just went straight down after that, and then it went back up. And some of the subscribers are talking about this, and I was like, oh, okay, I see this because I was definitely there. If this market is beating you up and your account up, you don't have to be trading right now. Like, trust me, I was there. I was behind the curve on this. But if you want to practice, try paper trading. That's how I cut my teeth too. Like when I was like, look, I know I'm just going to lose money in this market. I might as well just paper trade. So if you're getting worn out trying to decide where the market is going and still being behind the curve, just sit out until things get better. Paper trade, sit out, like whatever, just watch. Because I've gone through enough of these that I can actually see what's happening, what's coming, and I'm prepared for it. And it's pretty fun now that you're kind of like on it. You're like, okay, I see what's happening. This is cool. So your number one goal as a trader is to preserve wealth. You need money to make more money, no matter what your account size is in this business. That's literally the end game. All right. That's what you have. That's the most important thing. I don't care if you have $100 or $100,000. If you don't have money, you can't make money in this line of work. So preservation is the most important thing. So what's my plan during this downturn, correction, whatever it is that we're going to get? Well, I like to short the bounces. I'm in a couple of names I'm looking at. You know, I can add more if I need to, but short the bounces. Now that's going to be broker dependent. You know, I know when I put out trades to my channel, some people come back and say, "Oh, you know, Thinkorswim can't go short that or whatever." It's going to be broker dependent because you have to borrow the shares, and some companies don't have them to be borrowed in order to be shorted. Some of them might be expensive. I know I was shorting one stock and I got a notice and said, hey, instead of 3% interest, we're now bumping up to 28% interest per day. And I actually wrote to my brokers like, well, how much is that going to cost me? And they said, well, for the position you have, it's going to be $28 a day. I was like, whatever, that's fine. I'm only expected to be in this thing for a month, and I think it's going to go big. So it worked out. So just do that math. And then I'm also looking to go long UVXY. Now, UVXY is a perpetually declining product. It moves a lot. It's almost like trading options. But when it works out really, really well. But you got to be careful with it. It's hard for me to recommend it. You know, I'm trading it. I'm telling my subscribers how I'm trading it. But be careful with that product. It's a challenging one. Inverse ETFs, they're more linear. UVXY is definitely not linear to what the market does. So you could trade SPXS, SQQQ, TZA. You know, those are leveraged ETFs, inverse of the indexes if you want to. Now, this is not my strength, but you can sell calls, you can buy puts. You know, there are option strategies. I can't really recommend that. I don't know my thing about that. I'm like still dabbling, but those are things you can do. The reason I say that is because in a Roth IRA, you can't short things. You're not allowed to. Now, in a Roth IRA, you can buy inverse ETFs, or you can buy options for calls or puts. So if you really want some short exposure in your IRA, you can do options. Lots of watch list building for when the market bottoms. This is really, I think, where the money is going to be, because this is where we like the trend. Bull markets are longer than bears. Correct, you know, uptrends are longer than corrections. This is really going to be our job over the next few weeks to months. Is we need to keep looking around the market, figuring out what's holding up, what's going to come back when this is done, and we need to figure out where we can put the money that's going to explode when the market's done doing whatever it's doing. So that's really the number one thing, is keep an eye out. Just like that Hershey stock that I showed you from 2018, that's what we need to be looking for. That's part of what I'm going to be teaching, and that's part of what the Moxie Mastery is, my trading room is because I'm doing the work, constantly searching for those names, compiling them, building these watch lists so that, you know what, when the market comes back, we're ready to go. And so that I'm doing the work for you. So a lot of names right now are toxic. This is what I'm seeing. So many names are toxic. With steep downtrends, there are no buyers willing to step in. The only bounces we're seeing are short covering. They're just toxic. Nobody's wanting. Look at Roku. Does anybody want to step in there yet? I don't see any big names willing to step into that yet. Shop. Look at Square. Those things are in free fall. None of us are going to change that market, and we should not be stepping into those names. They are a long ways away from being in an uptrend. They probably have to hammer out bottoms before they can go in an uptrend. So just keep that in mind. All right, so here we get into the nitty gritty. I'll show you a couple short examples of what I've been looking at, how the market looks, and how I see it through the Moxie indicator. So this is RH, and you can see there's the Moxie price trigger on a weekly time frame, and it failed the moving average. And what has it done? Free fall. Now what you can see is, there's a little bit of a sideways move right here, and where did that correspond to? A tree branch. So keep that stuff in mind. After that, boom, it's probably going there. It might be going there. We don't know. How about on the daily chart? This thing had the Moxie indicator below zero for months, literally months before it started to roll over. This was all an inverse trampoline move. This is why I just wasn't touching this stock for so long, because I kept looking at the Moxie indicator. I said, this isn't ready. I don't even know what it's going to do, but it's not going to go up. And then it started actually confirming itself right here when price started to get stuck and rejected by the underside of the daily 50. Perfect setup. And then you can see here, look at this, downtrending hourly 200. It was great. And then when this thing really got on a roll, I mean, look at this thing. Now, do you want to go short this now? Probably not. You know, it's probably going to bounce or flag sideways, whatever. But you want to find the opportunities to short the bounces. That's what I'm talking about. How about this one? FLGT. Now, I was in and out of this thing. I really should have gotten back into this, except that I saw a lot of people say that they couldn't short it because of their broker. So I chose something else that I thought was similar to this, that it seemed like more people could short. But this is something that I had to kind of go through because I was short here. Market totally flipped on me, but I held through because I could see what was going on here. I was like, nah, this thing's going to turn back around. And I held on long enough. It did turn around. Basically turned into a small loss. It was like a 5% loss from like a 20 something. And I should have really just held on to it because ultimately it came down, flagged a little bit sideways, flagged right into the underside of the hourly 50. The Moxie indicator was super far below zero. It was a perfect short. It would have been great to get back into that. But again, I was in a lot of other names that were working out. So this is what I'm saying. There's a level here and it's breaking and it's easily going here and it might go here. So there is just a lot of what's going on out there that we can take advantage of. Because look at these setups. This was recent. This was last week of price running right smack into the underside of the hourly 50 with the Moxie indicator below zero. That's the Moxie indicator at work for you. How about DKNG, DraftKings? This one has been very, very long term. This thing's been just going down forever. Now, how did it start? It started with a Moxie price trigger. So the Moxie indicator got below zero, telling us it's negative. And look at this bear flag. Look at that. So perfect. It flagged right into the underside of a downtrending hourly 50 with the Moxie indicator super far below zero. That's a short. Then it hung out for a little bit. And what did it do? Basically just a bear flag. It was going nowhere to the upside. It was just flagging sideways, 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 sideways until it chewed through its support and it just kept going down here. And you can see it stayed underneath the moving averages. The Moxie indicator was super far below zero, and the 8 was below the 0. 8 was below the 21 the entire time. And it did it again right here. A little bit messier, but it did the same thing. And look at the Moxie indicator, super far below zero. So there's a lot of opportunity in here. I mean, this thing went from $60 to $20. Nice. How about TW? It was also head and shoulders. You can see there's the head and shoulders. But the other way that I look at it, there's the Moxie price trigger. There's price. That's the bounce. That's what I would talk about. So you can see there's the leg, there's the heel, there's the arch of the foot, there's the ball of the foot, and there's the failed ball of the foot. So where do you go short? Go short at the arch of the foot. So this is why I teach the things I teach, because it works out like that. And how about on the hourly chart? Inverse trampoline move. Awesome. You see something like that, inverse trampoline move in this market, that's shortable. It's a great entry. And it lines up exactly with the arch of the foot on the daily. You have two patterns lining up at the same time. I'd go with it. And then you look at this, look how perfectly this thing stayed below the underside of a downtrending hourly 50 with the Moxie indicator telling you it's pretty much safe because that indicator is so far below zero, it's not going positive. So there are some really, really good trends happening right now. And I know I showed you some that already had some big moves, but I think that there are still opportunities. How about Big Five? Just think about it on its face. You think Big Five really is going to hold up in a 20% market decline? We really think that's going to happen? Probably not. So with that in mind, we start looking at it and say, well, look, there's a level. Where is price sitting? Right at that level. Do we see any real layers of consolidation under here? Or is that just basically one straight line going up? Kind of looks like one straight line. No real consolidation. What about this? Doesn't that look like DKNG? Doesn't that look like a bear flag with price running right smack into the underside of a downtrending daily 50? Look how far the Moxie indicator is below zero. How about the hourly 200? It's in a downtrend. Price just bumping along here. It doesn't look like it's going to go up, does it? I could be wrong, but so far that's what it looks like. And where have we been seeing prices go to? So far, I've shown you many, many examples of where prices are going at least to the weekly 200. So just a guess, seems like that's a pretty fair place for price to go. And after that, there is an area of consolidation here, but what happens if price goes further? We don't know. We never know, but it's something to consider. And I think that there's still opportunity on something like this. So that's Big Five. All right. So if this is all new to you, and I'm sure it's new to some of us out there, and if it wasn't, I hope you guys really enjoyed this because it was really fun making. I had a lot that I wanted to say and show you out there because I was just like chomping at the bit of what's going on out there. But I've lived through multiple market downturns. As I said, I've seen this a couple of times. I'm getting the hang of it now. It's like, okay, I got this. I've seen what the market can do, and I've made almost every mistake in the book. I'm still younger than John Carter. So I want as many people as possible to avoid making the same mistakes. And I do that by showing you the way and by showing you what I've learned. Doesn't mean I know what's going to happen next. It just means I'll show you what I've learned. And although this seems scary, it doesn't have to be. I know the market's falling apart and it goes up and maybe you're in a short position and it bounces on you. It's crazy out there. But I call out trades and market commentary in my trading room. I give a ton of information. I give a lot of posts. I think my subscribers have been pretty happy about that because I just give them a lot of commentary of what's going on. And then I post what I hear from funds and other people in the industry so we know how to protect ourselves. That's my job, is to really see the landscape out there, compile it, and then bring it to you. That's my job. I eat, sleep, and breathe this stuff. I know you guys have day jobs too, so this is mine. And when to be conservative, when to go in for the kill. Hopefully you found tonight's information useful. And if you're interested in the Moxie indicator, the training room, or the upcoming class, here's the information. All right, so we've got the Moxie indicator breakout session, and we're going to be getting into that. A couple things I want you guys to know. We're going to be doing a strategy class February 12th. It's going to be live. It's going to be for a few hours. We're going to be talking about how to short things if you guys want to be shorting out there. It's great education since we have a lot of the material on the short side to be working with. I wanted to at least put something together. Even if we stick this on the bookshelves for years later, it'll be great reference material to come back and look at. And then also we're going to be having live trading February 15th and 18th, and that's for the pro package. So if you come over here and you see what we have, now for the basic package, all right, what you get is the strategy class. That's what we're going to be doing on the 12th for a few hours, talking about shorting, and then also how we can look for good names to the long side, like how to build your watch list for when the market's done correcting and all that. And then what you're also going to get is the Moxie indicator. Now, this is pretty killer. So for this price, you're going to be getting the multi-hour class talking about everything Moxie and how to do this. Plus, you're going to get the Moxie indicator. This is the single best tool that I ever need in order to trade using in the stock market. And you'll have this. You're going to own it. You're going to get to keep it. That's that. That is a great price for all of that. And then you're going to get the watch list, Moxie indicator watch list, and you get the Moxie indicator scans. Now, if you want to step up a little bit, we're going to do 2 live trading days over here, and that's included in the pro package. So February 15th and 17th will be there for easily 2 hours, if not more. Answer all your questions. We're going to be looking at what's going on in the market, see what we can do to take advantage of this. And that is a good way to really reinforce and instill the stuff that you've learned from the strategy class. So we talk about it, learn it, and then we go put it in action and answer your questions directly. And then here's actually a really good deal over here on the Elite. We're going to be giving you a discount on 1/4 of the Moxie Mastery. This is the alert service. This is my trading room. This is where I give out daily reports and daily interactions, and I put out just a ton of material, my commentary on the market at the time, what we're looking at, where we're going, everything that I'm seeing in the market. Plus, I also give weekly recap videos of what we've done, where we're going, and how things are going. So this is included. You get 1/4 of the Moxie Mastery, which is the trading room with daily reports. All right, so yeah, basic package in here. You can see what's going on. And then we get the class on the February 12th. And then in here in the basic one, as I said, you get the indicator, the Moxie stock scans, the Moxie stock watch list, and then you get the indicator install sessions. That's just to make sure that you get it up and running nice and smoothly. Pro package, as I said, you get an additional 2 live trading days. We're going to be on February 15th and 17th. That way we can actually put into action everything we just talked about and learned. And then the Elite package, you're going to get 1/4 of the Moxie Mastery, which is the trading room with all the live interactions, real-time trading alerts, interactive Q&A session, because I'm in there in the chat room. That's where you get direct access to me for 1/4. And then, so you guys can see here, we get the live trading schedule. So we do have the next one is February 1st, by the time you'll be seeing this. And then after that, March 1st, April 5th, so on and so forth. And then I do a couple bonus sessions every couple of weeks. I'll jump into the room, 30 minutes or so. It just kind of depends on what the market's doing, and we'll catch up and talk to everybody and say, hey, what are you doing? How you looking? What are you looking at? And see what we can do about that. All right. And then I actually did this when I had my own business and people wanted to come in, but everybody's got their own different account size. And if you're interested, PayPal does do a credit service. So 0% for 6 months. And hopefully, in the market, we can go out there and make some money. And we'll see if something like this is a good option for you to help cover the room costs until we get up and running. So as I said, remember, coming in through here, basic package, you're going to get all these things right here. You're going to get the strategy class. You're going to actually own the Moxie indicator. You're going to own the class. You can keep them, watch them forever. You can get the watch list, the Moxie indicator specific watch list. plus the Moxie indicator scans for bullish and bearish conditions. And then over here on the Pro, what we're going to do is add in those 2 live trading days. I always think that's great because that's where the rubber meets the road. It's like, okay, I just had class. Now I'm going to go put it into action out there. And then in the Elite, we're going to be giving you discounts on all of the above, including you're going to get plus 1/4 of the Moxie Mastery in here. So that way you can actually see how I'm doing, what we're up to. I can talk to you through the trades, and you guys get those weekly videos. There's just a ton of material. Like once you get in there, you can get all of the historical recordings that we have on there. So you can just have a field day once you get into the Mastery, the trading room, and catch up on all that stuff. So thanks again, everybody, for tuning in, and I'll see you guys later.